This is your daily real estate syndication show. I'm your host, Whitney Sewell. Today, we've packed a number of shows together to give you some highlights. I know you're going to enjoy the show. Thank you for being with us today. Kenneth, welcome to the show. How did you get into this business, for one? And I want us to jump in to, just the implications for foreign investors that not only the investors need to know about, but also operators need to know about. But how did you get into this space?
Absolutely. I actually fell into this space by accident, I guess, but, everything is for the good. I got my CPA over a decade ago, and I was working in Israeli firms, mostly doing, auditing and tax, for Israelis and internationally. I'm an Israeli CPA. And then afterwards, I kind of got into the US side after I was working in EY. There were two senior managers that decided to open up their own firm in somebody's basement, famous, basement kind of operations. And they took me in, and they were, their focus was only on US tax. They had two separate, things, either Israelis or people that don't live in the US, but they're US citizens and they need to file because they're expats. And the other group was also people who don't live in the US, but are also not US citizens, and they need to file in the US because they have real estate investments in the US. So I kind of got into that, and I saw, that's what I wanted to do. So I went and I got my EA from the IRS and, learned on the job. And that's what I've been doing for the last 7-8 years. Focused, like you said, hyper-focused on this specific topic. So, yeah.
Well, let's talk about, I guess let's first start out for just the implications for the foreign investors. And let's talk about, what they need to know, as that investor, they're looking to invest in the U.S. We have some foreign investors personally and numerous others that would like to partner with us. And, and so we've had to learn a little about this, but I personally would love to know more. And I know many of the listeners as investors and operators would as well. But can you just walk us through some things that, the implications for that foreign investor, things they should know, and let's dive into some of those things.
Right. So there's some technical things and there's some, more serious things. Obviously on the technical level, planning on, how they're going to structure their investment and how they're going to operate themselves. Often they're going to be passive investors because they're not physically in the U.S. So in terms of structuring it, and from a legal perspective, taking into account their home country as well as what's going on in the U.S. In order to avoid double taxation and terrible things like that. On the technical side, it's you have to get an ITIN, for example, right? If you're not a U.S. citizen, you don't have a social security number, they're going to have to get an ITIN in order to file taxes at the end of the year. And in terms of the structure also, people often, like the structure with, the LLC. It's not always the best structure for foreign individuals. And depends really what country they're in, and what their purpose is. Bottom line, there's a lot of planning before they invest, and there's a lot of homework that they need to do. So I try to keep that, that pretty simple and straightforward by asking them a few questions beforehand, just to understand what type of investor they are, what their long-term goals are. And based on that, we can, build a process for them that's unique for them, because there is no one size fit all.
Are they able to avoid double taxation?
Of course. Just with good planning, they can avoid it. Double taxation in general, if whoever is not familiar with the term, is when there are two different countries that want to tax you on the same income. Okay, so in this case, when you have real estate rental income, that's what we're talking about mainly. The U.S. wants to tax that rental income because the real estate is in the U.S. physically, and the foreign country wants to tax that income often because the person that owns the real estate and is getting that rental income is a resident of that country, and in many countries, the country taxes their residents on their worldwide income. So when you have that clash between two countries that both want the same income, you have to first see if there's a tax treaty between the two countries. Sometimes you have a tax treaty. Some countries don't have a tax treaty with the U.S. So if there is no tax treaty, it's a little more complicated, and there might be double taxation in certain scenarios. But with many countries, there is a tax treaty, and pretty much the way it goes is the tax treaty will say, okay, the real estate is in the U.S. on U.S. soil. The U.S. will get the first right of taxation, and then when the foreign country wants to tax them, they don't pay the full tax again. They get a credit from what they paid already in the U.S. And if there's any difference, then they would pay the difference. For example, if the U.S. taxes 10% and the foreign country taxes 15%, so then they won't pay 10% plus 15%. They'll pay 10% in the U.S. and then just another 5% in the foreign country.
Okay. No, that's interesting. It's great to know that there's even just to understand that both countries could potentially be taxing you if you don't set this up correctly. What about, you talked about the need for, I think you said an ITIN, or LLC. How difficult is that to obtain for the foreign investor?
It's not that difficult to open up an LLC. Most LLCs can be formed online. And you don't have to, go into the U.S. for that. It might be a little more difficult opening up a bank account because they're a little more, they scrutinize every single person that comes to the bank. But that we can work around that. Also, the ITIN is a little more difficult because in order to get an ITIN, the IRS, in theory, requires the applicant to send in a form together with their original passport, their original valid passport, together with the application to the IRS by mail. Okay, not a copy, and that's something that many people. The actual
hard copy of their passport.
Right, exactly, but they don't really have to do that because the IRS understands that people are not going to want to send their passport book to the IRS, and who knows when they're going to get it back, if they'll get it back, even though they're supposed to return it right away. Anything can go wrong. So the IRS appointed and trained agents all over the world that can identify the applicant instead of the IRS. Okay, and these agents are called CAAs, Certified Acceptance Agents, and in every country you'll have multiple CAAs. So the applicant, the foreign investor, can just go to one of these CAAs in person, so that the CAA can identify them and make sure that their passport is valid. And then the CAA will just make a photocopy of the passport and send it to the IRS with their signature on the application, and that's how they get an ITIN. Although that takes a few months also until the IRS actually issues the ITIN, especially now. Plus, the IRS doesn't give out ITINs to anyone, so you have to have a reason for requesting an ITIN, and the most common reason is because they need to file a tax return. So the application for the ITIN is submitted together with their first ever tax return.
Okay. So it's good to know that you don't actually have to do that. I can see why you would not want to send your hard copy, especially if you travel quite a bit, right? I mean, you're going to be grounded then for however long it takes the IRS to get that hard copy back to you. And so that's a real dilemma. What about those bank accounts though? How do they get those open?
Right. So first of all, not every investor has to have a bank account open. Okay. They can operate with their foreign bank account. Depending on what the structure is, usually, especially if they're foreign, if they're passive, if they're passive investors, and they're just going to be getting, they're going to be getting funds, once a quarter, once a year, then, whatever operator is handling that can just, transfer the funds overseas. But if we're talking about somebody who, wants to, buy real estate and have it under their personal name or their personal LLC, and kind of like be a little more active and involved themselves, there are ways around it. Obviously, the best way is if they're going to be traveling to the U.S. anyway, walk into a bank and open up a bank account. There are certain banks that allow non-residents to open bank accounts from afar, but it really depends on the bank and on the situation. It's not like there's a rule for for all the banks that apply for everyone. It just, every bank is different, but it is possible.
Yeah. Well, I know the structure, like you mentioned, is different depending on where this foreign investor lives, what country they're from. Could you just maybe lay out an example structure for like India or China, or, I feel like those are a couple of very common countries that I know we receive investor, inquiries from. Is that something you just kind of help us to think through that a little bit, what that investor needs?
Yeah, I mean, obviously, what's close to in my backyard is Israel, where I live. So I can definitely give you a lot more examples of how things work in Israel. Obviously, every country is different, and before we have any investor, we look into the rules of that country. But since I focus on the U.S. side, I'm always going to be in touch with the local accountant as well, because I can't possibly know the tax laws in every single country in the world. So it's definitely, we need to cooperate with the tax professionals in that country in order to see what pitfalls can be over there. Some of the examples can be, like I mentioned before, the double taxation issue if there's no tax treaty. Another thing, totally forgot what I was just going to say. Anyway.
No, just the structure of, if you were going to use like an investor from Israel, just the type of structure that they would need, for example. Right.
The other thing I remember, the other thing that you have to be aware of is estate tax. There's estate tax exposure that's very different from U.S. citizens. As you know, even though it might change or is changing all the time, the estate tax exemption for U.S. citizens, is currently, like $11 million of assets per person, and for a foreign person that has assets in the U.S., the exemption is only $60,000. So that's definitely something that needs to be planned out ahead of time in order to avoid that structure. Either that or just live by the saying, you're not allowed to die as long as you have U.S. real estate. But if you want to plan a little better than that, then there are other ways to get around that. Instead of, for example, investing as an individual, they can invest through a foreign corporation. Which invests in the U.S. that can take away the estate tax exposure. Obviously, there are ups and downs for everything. So even though that solves the problem with the estate tax, but you might have higher taxes, income taxes along the way because of the corporate tax and the way it's structured. So I think that's the main thing that you need to understand is everything.
Yeah.
Everything.
That's some great things to
really
think about.
Yeah.
For sure. As that investor, I don't know, before we started the recording, we're talking just a little bit about how a lot of operators are just, turned off by, foreign investors. Like they just say, nope, we're not going to do it. No, sorry, and close the door on it. And so why, on the operator side, why should they, not just turn that, shut the door on that completely? What are some things, they need to be aware of as operators?
Why should they not shut the door? Obviously, right. They should not. They should not shut the door because there are plenty more investors that they could possibly have all over the world instead of limiting themselves to the U.S. Obviously, that's the best reason. But ultimately, if the investor has a proper tax professional that's helping them along, there's absolutely no reason to be deterred by that. What the operator is going to have to understand, although they're also going to have their own accountants and tax professionals going to help them with that, they're going to have to withhold taxes, for the foreign investors, as opposed to, U.S. People that don't need withholding. They're going to have to be aware of different types of withholding, not just, the regular withholding from income tax. If we're talking about passive investors in a syndication and a partnership, but if there's no partnership, if we're talking about somebody buying real estate, buying a house from a foreign person, okay, then you have something called FERPTA. I'm not sure if you heard of FERPTA, but FERPTA is a law from 1980 that basically says that if you're buying property from a non-U.S. person, you have to withhold 15% of the sales price, not the profits, the sales price, and only give 85% to the foreign seller and 15% to the IRS. And there are a lot of different ways for the foreign seller to get that money back, because it's usually too much tax. And we can get into that a little deeper either later today or next time. But what I wanted to say about this,
I was just going to say, that operator, how much do they need to be withholding taxes? What do they need to be doing? As let's say we have an investor that's investing in a deal, and we're paying out distributions within maybe the first month or first few months, and monthly thereafter. What should that operator be considering?
Exactly. That's exactly what they need to understand, because the IRS is relying on them essentially to make sure that they're going to get their taxes, because they don't rely on a foreign person. They're afraid that the foreign person is going to run away to a foreign country and they're never going to see, tax from that income. So they're relying essentially on the partnership or on the operator or whoever is sending the money overseas to the foreign person, relying on them to withhold tax according to the proper amount by law. So that's not necessarily something that the operator has to be concerned about on a personal level, because again, that's something that's done in the back office, with the tax, accountants, they do the calculations. But yeah, it's definitely something they should be aware of it at some level.
We personally send out the distributions, like our accountant doesn't do that, on a monthly basis. We personally do that. And so should we be withholding some tax money there, from those foreign investors, even on a monthly basis as we send those distributions?
Possibly. It really depends on the tax calculation. Okay. It's not necessarily on the actual distribution, because the distribution could be based on other things and not necessarily on how much income there was.
Sure.
I'll give you an example, right? If you have a depreciation, especially if you have a cost segregation study, right? If you're familiar with the cost segregation, it's essentially accelerated depreciation, and it's a tax deferral method. So what that means is that you'll have cash in hand to distribute to the investors, but from a tax perspective, you might have a loss on the books. So if there's a loss or a lower amount of income, then there's going to be a lower amount of withholding. Okay, so it's not necessarily the amount that you're distributing, it's the amount that you're distributing that's classified as income. So that's where the accountant needs to be involved regarding the distributions. It doesn't have to be with every single distribution. It's essentially a quarterly withholding estimate that needs to be sent to the IRS based on the tax calculation. So it's a quarterly calculation, but essentially what you need to understand is that the amount that you're going to be transferring to the IRS is also considered part of the distribution to the investor. Okay, so if you're telling the investor, okay, I'm going to give you whatever, $100, but you have to give $10 to the IRS, you're only sending over $90, but essentially you're giving the investor, you're distributing $100, not $90, because the investor will have a credit for that $10 on his tax return when he files a tax return the next year, and will either get a refund or that'll just be on the account of their taxes that they owe. So that's why you need to that's some great to be involved. Yeah, great information. It definitely, just some examples why our team's so important, and having somebody like yourself on our team, it just to better understand and ensure we're doing that properly, and we don't get
caught behind there, or years into it, and we haven't even, thought about they have the tax implications for our foreign investors. So anything else as far as for the foreign investors specifically, or for the operator working with foreign investors that you want to leave us with, Kenneth, before we have to move to a few final questions?
I just want one more sentence about that withholding. Like I said, the IRS is going to be coming after the Americans, not after the foreign people. Okay, because if you decide, okay, I'm going to give the whole thing to the foreign people, I don't care, whatever, let them figure it out. No, it's not their problem. It's your problem, because if you distribute all of the money to the foreign person you weren't supposed to, and the IRS will still come to you and say, I still want my tax withholding. Right. So you're going to have to figure out how to get that money back from the foreign person or take it out of your pocket. So that is definitely something to just to be aware of. And take that with you to the next part of this conversation.
Brian, welcome again to the show. It is a topic we've talked about numerous times on the show, but probably not often enough. I still get questions all the time about, self-directed IRAs. Is this for me? When should I do this? All these things, right? Or the different types of deals that they can use to, use their self-directed IRAs to invest in. And I'd love to get into that a little bit. And then, the different tax implications as well, right? It's sometimes questions people have, but then a lot of times people don't even know to ask those questions about the tax implications. So I'd love to get into some of that as well. But give us a little more about your focus right now, Brian, at NewView, and let's jump in.
Yeah. So, obviously, since the pandemic, things have kind of changed. So I've kind of adapted to the new normal. I'm jumping on podcasts and a lot of virtual meetups. We have virtual conferences that have been very successful. And I kind of like this new normal because I'm able to touch and network with people that I probably would have never networked with before, thanks to more people being active on LinkedIn and creating more meetup groups and more podcasts than I've probably ever seen in the last 3 years.
Yes, for sure. It has changed everything, or the way most of us do business in a big way. But, let's jump in. Obviously, our work using IRA, self-directed IRAs is your specialty, right? In helping people understand this. Tell us, as you work with operators in our business, working with lots of investors, I would like to talk about maybe the different types of deals and the way people use their IRAs to build wealth, in syndications. Could you just elaborate on that a little bit? Maybe some options there that people don't normally think of, and we'll talk about different types of deals.
Yeah, for sure. So, syndications is great. It's been around for a while now, and I don't think enough people get involved or learn about it. So I've actually done my own due diligence to learn more about syndications. I've been reading books, like there's a book by Robert Beardsley about underwriting for syndication deals. And I'm just doing my own research and my own networking to learn how those syndications work. And one of the newest things I've kind of learned is, whether you're doing a 506C or a 506B, it makes a big difference whether you can talk to those self-directed IRA investors or not. You might be limited to accredited investors, or you might be able to, pitch that deal to your, network of good friends and family that could potentially invest with you. So that's probably right now what my focus is just, learning myself how the syndications work, what kind of deals are being created, how much capital they're raising, because that does affect NewView as well. If anyone's raising under 5 million, that would be a retail client. If anyone's raising over 5 million, that would fall under our institutional assets, which usually works with like broker dealers. And, it's a larger group of people raising a lot more capital.
So let's talk about the 506B, 506C thought just a little bit. Does it matter as far as, your IRA investor, if they are investing in a 506C or B? Let's assume they're accredited for the sake of that. But, when they're specifically using their IRA, any differences in a B or C that they should be aware of?
Yeah, there are some differences. Obviously, accredited or not, that limits the amount of people you could probably that have those IRAs. There's probably a lot more people that are accredited and would probably prefer to use their own cash versus using their IRA funds. And, everyone's different. Everyone's, methods are different, and everyone wants to invest their money wisely, of course, because this is their retirement money that they're talking about. But whether they're accredited or not, whether it's 506C or 506B, it doesn't matter. Everyone has a retirement account. Now, if it's with their current employer, it's probably tied up and they won't be able to use those 401ks, 403B type of retirement plans. If they have IRAs, well, how much do they have in that IRA? Is it enough for, maybe that minimum $50,000 to get into the deal? It might not be enough if you're talking to those non-accredited investors. However, those accredited investors, like I said, they're not always looking to use that IRA money. They might have it invested in other things like stocks, bonds, or mutual funds. So there's challenges on both sides, but there's also potential, on both sides to have more investors that would use this type of capital.
For sure. What about just the tax implications? Maybe you can highlight some things that an IRA investor, they need to ask, right? They need to talk to their accountant, or they need to talk to somebody like yourself, or they need to at least ask some questions. And I find that often we don't know to ask these questions, right? Or there's questions that you just don't know till you get into it. Sometimes it's too late. But what should they be asking about taxes?
Yeah, that's a great question. Something that comes up very often day to day for myself. So there is a taxation. It's called UDFI or UBIT, and this occurs whenever somebody, especially in real estate, you see it. If you're investing into a business, which it would be the LLC, or if that business or that real estate deal is using leverage, you'll be subject to a taxation. It scares people off sometimes, and sometimes even the syndicators putting the deals together don't understand how the UBIT or UDFI works. There is one plan, though, that is exempt from that. It's called a Solo 401k. Some people call it an individual K, or we call it here at NuView a Solo QRP. That plan is exempt from UDFI taxation. That's the only plan that would be exempt from that.
A Solo QRP. And who's eligible for that? Is that anyone with an IRA? Is that, they can, walk us through that process a little bit of that, having that Solo QRP.
Yeah. So in order to be eligible for that type of plan, you have to be a self-employed individual with no common law employees. You could be in a partnership. It could be an S Corp. It could be a C Corp. The only rule is you don't have those employees. You're an entrepreneur, you're self-employed, and you are earning self-employed income. If you meet those qualifications, you're eligible to have a plan like this. It's a great plan. It has high contribution limits. You can contribute as the employee and the employer, because you're both, you play both of those roles. So as the employee, you can contribute up to $19,500 a year. You can decide if you want it to be pre or post tax. The perk of it being exempt from that UDFI tax is huge. Also, you can take loans against it if you needed to. If you're doing your own deal and you wanted to buy a piece of real estate, say you rolled over some pre-tax money from a traditional IRA you had existing into this 401k plan, well, you also could use leverage and you're not going to be taxed at UDFI as well if it's your own deal. So there's a lot of great, perks of having this plan and being eligible for that. The reason this plan was created is because not enough self-employed individuals create a retirement plan for themselves. So it has a lot of catch-up contributions. And on the employer side, you can contribute up to a 25% match of your earned income for that calendar year. Maximum would be $57,000 if you're under the age of 50. There's an actual $6,000 catch up if you're over the age of 50 that most people don't know about as well.
Brian, I guess speak to, you talked about like the new norm, right? For right now, and just after the pandemic, or, still going through it now, or the aftermath. So tell me, what's that done for self-directed IRAs? Are there more passive investors looking for this type of thing now? Are there less? How's that affected that industry?
Yeah. Okay. It's a great question. So 2020 was actually, I think a lot of people were hesitant on what they wanted to do, but from all the conversations I had through 2020, people were scared to move their money around, but they didn't want it in the stock market. Like, they wanted their money to be safe. So they were kind of holding on to it. 2021, actually December, once the vaccines were released, I think people got a little more comfortable. Our phones definitely were blowing up. A lot more people are interested in investing in alternative assets. That is one of the best ways to control your money. It's one of the best ways to pick your own investments and diversify your portfolio. I am non-fiduciary, so I can't tell my clients, what to invest in, what's a good or a bad deal. I can help them ask certain questions for due diligence, but they should always seek, an attorney or a CPA for those types of questions. But we're seeing a lot more people investing in things like cryptocurrency, definitely syndications and real estate in general. A lot more people investing in, private companies. I myself, invested in some of the vaccine companies, and I moved some of my money in that, even though it was a stock market. I saw some potential there. And a lot of things are evolving and changing. And I think, we still haven't really seen the surface of what the new normal is going to be like when people are using retirement money for investments. Until maybe 2022, we'll start seeing some trends.
Okay. No, it's just interesting to hear how the pandemic has affected, all parts of our industry. But I wanted to go back to and think about, I know we haven't talked about this in a while, but I thought you could shed some light on just like the prohibited transactions and what that is. And because I think there's some confusion there often as far as, using my IRA and maybe what is prohibited.
Yeah, for sure. So prohibited transactions are pretty straightforward for the most part. There are what's called disqualified parties that you're not allowed to do transactions with, or you're not allowed to invest in their companies. If it's a piece of real estate, these disqualified parties could never live or rent that property. They also can't put any sweat equity into it. So these are the disqualified parties. So the IRA owner and then their spouse, both of their parents and their grandparents, their children and their grandchildren. So those people are disqualified parties. So when it comes to anything prohibited, there's a few things you can't do. You can't invest in collectibles, and you can't invest in life insurance. You also can't do transactions between those disqualified parties that I mentioned. There's one other disqualified party a lot of people don't mention, and it would be anyone that's fiduciary to the IRA owner.
That's good to know, right? We can't invest like alongside our brother or our son's property or something like that with our IRA, correct?
Yeah. So brothers, sisters, aunts, uncles, cousins, nieces, nephews, of branches of your family tree, those are actually okay. Those are not disqualified parties. Okay. It's just your ascendants and your descendants that are your linear family tree that are disqualified.
No, that's good to know. What are some ways, I guess, you've seen people, I guess, do you know the percentage of like the people that are using their IRAs to invest in real estate specifically, but in syndications versus, say single family homes or their, other types of asset classes?
Yeah, I don't have a rough percentage, but I just know here at NewView, I'd say in real estate in general. So I'd say 75% of our clients invest in real estate. In general, whether it's a rental property, an Airbnb, or buying land. I'd say out of that, 75% of our clients, probably maybe 25% of them invest in syndications. Now, there's $11 trillion in retirement money that is out there. And a lot of these syndicators don't realize the power and how much capital they could be getting by just mentioning, do you have a self-directed IRA? Asking their clients and their investors if they have IRAs. I do want to tell a story. I was at Grant Cardone's 10X conference it was 2020, actually right before the lockdown. And he had a questionnaire that everyone was filling out when they were checking in. And you know what that questionnaire asks at the very bottom? Do you have a 401k or IRA? And he's maximizing on that opportunity. There was over 6,000 people there live. So, he has a team of people dedicated just for self-directed IRAs and, maximizing on that opportunity.
That is a great idea. And so he added 6,000 people probably to his investor list, right? Yep. As he is, obviously, holding those events and whatnot. As you work with operators, what's some of the best practices that you've seen operators have when working with investors that have IRAs, but even with you as a custodian?
I think you said best practices.
Mm-hmm.
Okay. The best practice is to definitely get to know, have a point of contact at your custodia, whoever you're working with. And it could be multiple custodians. Most people do that. They like to give their clients some options, but make sure you have a go-to person that you can build that relationship with, because there's a lot of opportunity you might be missing out on. So here at NewView, we have the opportunity for syndicators to contribute articles to our clients, where we put it in our newsletter and our blog and our social media. We have webinars that we do weekly, and we bring guests in. For example, we'll be bringing in a pretty big name, I think. Vinny Chopra will be speaking on, senior living pretty soon. And I'm pretty excited about that. But not only the webinars, we do virtual conferences. And we're always looking for guest speakers. And these guest speakers are maximizing on these passive investors that are actively seeking a good investment. They want to be educated. They want to learn about these things. And other custodians don't offer this type of education. Now, like I said, we're non-fiduciary. We can't tell clients what to invest in, but we can provide education. So if you're a syndicator and you have educational material, and you're working with a custodian, see if they're willing to put that out to the clients.
Any big mistakes that you see passive investors making with IRAs within, investing in syndication specifically?
Any big mistakes that they make?
Right.
That's a really good question. And I'm in the sales department. I work in business development. I'm that first touch with the clients. I help them establish their account, get the account funded, and I'll follow up with them for the first 90 days. I can't say that there's any mistakes that they make. The only thing I would suggest is that if they do decide, because that's a passive investment, if they decide to be an active investor and do their own real estate deals, to definitely learn what the prohibited transactions are, the disqualified parties, and learn other opportunities, because they're going to be getting their returns and that money's going to start accumulating and sitting in cash. And I think that the investors, these individual investors, don't realize that their money's sitting in cash and they need to do something else with it. Whether that's putting it in a brokerage, precious metals, maybe until they have enough to put it in another syndication or another deal, or buying their own single family, property that they can get some rental income off of.
Any other methods for just ensuring we're using the tax-free methods through our IRA as much as we possibly can?
Well, I think that having different types of IRAs is pretty important. People don't realize that, a Roth is pretty powerful in a lot of ways. You pay the taxes on it now based on what your tax bracket is at that moment. But once you've invested that money, it's going to grow tax-free for you for the most part. Of course, unless there's leverage involved and there's some UDFI taxation. But even with that taxation, you can still get tremendous gains and build your wealth and retire more than comfortable, which is what I think most people want to do in America. That's the American dream, is to be able to just retire wealthy and enjoy that retirement, because you've worked so hard and put that blood, sweat, and tears for so many years. So, pay attention to what your money's doing, figure out other strategies and other ways, build a relationship with a good CPA that can help you build those strategies. That's the advice I would give probably to, my clients.
Thank you for being with us again today. I hope that you have learned a lot from the show. Don't forget to like and subscribe. I hope you're telling your friends about the Real Estate Syndication Show and how they can also build wealth in real estate. You can also go to lifebridgecapital.com and start investing today.